Hey, what's going on, everybody? Welcome to Bonafide Investing, where we talk all things high yield investing, options, futures, investment goals, investment ideas. If you're new to the channel, welcome. To give you a little background on the channel, I took about 20% of my net worth. I put it into what I call a all-weather high yield portfolio that I've called Cash Flow Life here. This seeks to, number one, pay my bills, and number two, maintain and pay down my margin over time. I do not tout this to be the only way to invest. This is not the only way I invest, but its sole purpose, again, is to help me live free from 9 to 5, pursue hobbies, spend more time with my kids, and really just do the things that I want to do. Please hit like and subscribe if you like what we're doing here at the channel. Please help support the channel. Everything we discuss here is not investment advice, not now, not ever. So please do your own due diligence before making any investment decisions. I was once a financial advisor. However, I'm not responsible for your wins or losses. Hope you all had a good week. And I want to talk about just a portfolio update today. The week prior that we just had, what I think is coming the week ahead. Again, my opinions only. But want to talk about just some of the updated numbers here. So I did get rid of YMAX and KYLD. KYLD cut their dividend, their distribution by about 35, 40%, with not even really an official bear market or any sort of severe correction. So that didn't set well with me. I let that one go. Again, never stay married to ETFs or closed-end funds or stocks for that matter. You've got to adjust, right? To maintain sustainable cash flow, you got a dollar cost average. You've got to know where to make moves. And I thought cutting YMAX and KYLD was a good thing to do in the moment. We'll see. Will I buy them back in the future? Maybe, maybe not. Again, it just depends on what markets are doing, where things are going. I said in an earlier video, I never expected to own Ulti and Salty in 2026 again, but here we are with a pretty significant allocation to both of them. So again, just, rolling with the markets. KYLD and YMAX I won't hold them for at least, roughly, 30 more days just to lock in any sort of loss I might have. I'm actually going to go back and look at that. But I did buy more of Ulti and Salty. I added more to QLDY, which is becoming my favorite NASDAQ high yield ETF. And I added more to TLTW as well. To give you some numbers here with what's going on, margin buffer is at 61.32%. Again, I like to stay above that 50% margin buffer just for peace of mind. The way I'm currently allocated, every roughly $10,000 Cash Flow Life goes down. My margin buffer drops by about 1%. I really like that ratio. I don't know if it will continue. Who knows? I've said in the past, be very careful, as all brokerages, Robinhood, E-Trade, Schwab, they can raise your margin maintenance without notice immediately, triggering all sorts of problems if you're using margins. So always watch your margin each and every day. The good thing is all of my ETFs and closed-end funds I'm holding right now are at 25% margin maintenance. But if Robinhood ever changed that, I would probably make changes as well. Currently using $160,427.30 of margin, $451,074.36 of my equity. That's a portfolio total of about $611,502. Now, based on the most recent updates with distributions from this past week, shares owned, most recent distributions for each of the holdings, we have an annualized income of $173,856.24. That is on, again, that $611,502. That is a 28.4% annualized yield. I really like staying in that 25 to 30% range. YQQQ about doubled their distribution from the prior week, and Roundhill, their distributions came up a little bit. So I think that was the reason for the roughly 4% boost in the overall portfolio income annualized from this past week. So really happy with those numbers. Currently, just to kind of break down the portfolio right now across the short ETFs, the inverse or short ETFs, those basically salty and YQQQ. We've got about 26.5% of the portfolio allocated to those. That's a number I feel good about. Again, I think these markets are headed down. Yesterday morning, I was really surprised when the 10-year yield was down significantly and indices were up. And I think I said, like, in my video yesterday morning, I was really surprised the markets were up. They ended down and flat. The NASDAQ actually ended slightly down, S&P pretty flat, which, that made a little bit more sense. Markets are acting very deflationary right now. I think there's a lot of pressure to the downside for equities, for a lot of assets that are overvalued. So until that changes, I like having that 26.5% short exposure. And that does not include, right, the long puts that I have on QQQ and SPY, as well as the long calls I have on VXX. So it's not much lower than what my long ETFs close-end fund currently are at, which is 30.7% of the allocation. Fixed income bonds, I've got 8.9% allocation. That's strictly through TLTW right now. I don't know if I wouldn't add so much longs outside of my dollar cost average, but if I'm going to add more, if I want to use more margin right now, I'd probably add to the bonds, the TLTW. I'd probably bring that up closer to 10% of the portfolio. So I might look for areas that I can trim across cash flow life to maybe put more into TLTW. Gold, real estate, those ETFs, I think there's about 5 of those, 21.8%. The goal right now, after gold's big run, forgive the dog if you can hear him barking. He thinks he's a tough guy right now, so I apologize. But gold right now, real estate, my target goal is 20%. 21.8% is a little high, but not displeased with where that currently sits. Right now, no crypto ETF specifically. Options values right now make up about 4.8% of the portfolio. That's the VXX, the SPY, and the QQQ option values. And then finally, the high yield ETF exposure is strictly through ULTI right now, ULTY. That's making up about 7.3% of the portfolio. So right now, my margin usage is 26.23%. My equity usage is 73.77%. So I'm at the higher end of the equity that I like to use. As a rule of thumb, I really don't go over 30%. Would I ever go over 30%? I think if we had a severe market crash, I would probably use much more margin. So I want to give those stats there, that updates. I did make a trade on HIMS stock on Monday. What I did was I actually bought it. I bought a call on HIMS on the Monday morning open. It was down about 23%. And then I sold it later in the day when it had rallied back substantially. It was a quick $150 or so. It was just kind of a day trade. They got sued by Novo Nordisk. Usually when those things come out in the news, it's already priced into the stock. So wanted to just day trade that. Starting to see a little bit more opportunity. Someone made a good comment this week that I haven't really been trading a lot of options, and I have not. I haven't really seen a lot of opportunity. I'm starting to see a little bit more. I might start the wheel on a few individual stocks this week. We will see. You've heard me say it many times. I don't trust Robinhood's performance. The NASDAQ was down about 2.1% this week. S&P was down about 1.4%. Cash for Life was supposedly up 0.92%. I don't know if this takes into distributions. I don't think it does. But again, all of my bills come out of Cash for Life, and all of my income from my ETFs and closed-end fund, they go into Cash for Life. So again, I just don't have the time, nor do I want to spend time right now going through all that. But Cash for Life held up pretty well for the slightly down week that we had. It's funny when you see all the headlines and all the fear in the markets from a 2% correction. That makes me think that this market could still go much, much higher. I don't know. We might test the recent highs before headed lower. Nobody knows. I think next week, this coming week, I think we will head down. I really think that we are long overdue for even a 20% correction. Markets, again, don't care what I think, but I think that we need some sort of healthy washout of the excess. Remember, the lower markets go, the less risk there is. But, looking at the CNN Fear and Greed Index, we spent most of the week in fear. So again, when you see fear in the markets, I don't know if we will have that washout, right? It's usually when we have greed, extreme greed, and people are all in. That's when we get those really severe downturns. That's why I don't think if we do have a downturn, I don't really think we're going to have that huge collapse, that 70 to 90% collapse that I've been saying is coming, that once in a lifetime market crash that I personally think is coming. I hope I'm wrong. But again, a 20% correction would be extremely healthy for these markets. I think what gold and silver did end of January with their washouts, crypto, Bitcoin especially, I think that's extremely healthy to get the speculation, the froth, the excess out of the system, so that assets can continue higher in a much more healthy way. Some of my thoughts around this, again, what's coming up. Interest rates have been coming down. I've been saying since December rates would go up. I thought the 10-year would hit closer to 4.5, right in that range. It got up to about 4.3-ish, and now it's come back down closer to 4, right? So that's very deflationary. And what that typically signals is that asset prices should start coming down. They should start coming back to reality. I think that the stock market needs a washout the way that gold and silver did, the way that crypto did, and the way the bond market did in 2022 and 2023. So we shall see. I think we will head lower this coming week. And what I did on Thursday, when we had gold was down over 3% that day. The NASDAQ was down about 2%. S&P 500 was down over 1%. So I doubled my dollar cost average for that day, just like I did the prior week. There was a couple of days I did that as well. What I did this time, though, if you remember the previous week, I put $40 into QDTE, QLDY, QQQI, XDTE, and SPY-I. So that was an extra $200, $40 across those 5. What I did this time was I put 25 into these same 5, $25 each, but I also put $25 into GLDY, IAUI, and IGLD, since gold kind of really got hit hard that day as well. So on those 1% plus down days, my goal right now is to dollar cost average double that day. Okay. So what I might do if there's an asset class down over 1% now for a day, I might just double what I normally put in. So if my target for gold, for example, is 20% of the 200, right, which is $40 per day, I'm just going to put $40 back into gold, right? If REITs get crushed, I might put an extra $10 that day into IYR. So what I think I might do now is if an asset class is getting completely smashed or multiple, I'm going to dollar cost average back into those. But I'm going to stick with my S&P 500, NASDAQ, dollar cost average doubling, where if they're down on 1% or more for the day, I'm just going to double that day. So yeah, again, I don't think there's a lot of value still in these markets. I had a good question about Palantir. If I buy Palantir calls here, absolutely not. I would not. Do what you want to do. Again, nothing here is investment advice, but Palantir is far from cheap. I think $50 is almost fair value for Palantir. So again, there's still a lot of froth, a lot of excess. I think a lot of tech is still not cheap. I think there could be some opportunities coming. There are some calls I might be buying, even some long puts on some companies, looking at some charts that are looking pretty enticing. Again, every trade will not always win, but I like to use charts to up my chances, up my probabilities, of winning in a trade. So yeah, might start the wheel, might start some calls. We shall see. That's kind of the game plan for this coming week for me. Until then, I'm going to keep doing dollar cost averaging $1,000 per week back into the strategy, TLTW all the way through IYRI. I am not dollar cost averaging through ULTI, SALTI, or YQQQ. I really like the new look of Cash for Life. I like that I've pared it down some, getting rid of a few positions, fewer overall holdings. I did make a comment yesterday that better ETFs will come along, and I'm a firm believer in that. I think that this new high yield space is new, right? A lot of these zero DTEs, a lot of these covered call funds are relatively new compared to, passive index funds. I heard somebody out. I had to keep myself from laughing. It was kind of a tongue in cheek, bite my lip kind of thing. But someone tried to tell me that high yield investing is a bubble. And I don't know. I asked for data in a nice way, and it's just kind of an emotional rant on their part. But if we're in a bubble on the investment side, it's on the passive side, and it's on the passive side by a mile. So as a matter of fact, in a video in the past, I said that I think we're in a passive bubble where the set it and forget it approach is going to be completely miserable. I think it's going to be a complete letdown for a lot of investors over the next 10, 20, 30 years on the 60-40 portfolio, that kind of allocation. So I think high yield investing, and I'm a passive investor in a lot of my accounts. I invest passively, set it and forget it in some of my accounts, but for growth, what have you. But on the high yield, the high income space, it's still a very small cohort, a very small amount of investors, I think, doing this. So keep that in mind. Don't let people tell you it's a bubble. As a matter of fact, you've got all these, option ETFs coming out, all these things, and they don't affect the options markets. They're not skewing them. They're not making them unhealthy. Option markets have been around since the 1970s in the form that we understand them. And, there's always a buyer and always a seller on a trade, right? So that keeps markets healthy. So anyways, ignore the noise. I had a good laugh out of that comment that there's a high yield bubble. No, not at all. So anyways, if someone has data that can prove me otherwise, please show me. But again, this is a very small amount of investors if you look at AUM, assets under management, compared to many passive ETFs and mutual funds out there. So I think the Russell, the small caps should do well until this bubble pops. And it's everything bubble, whatever you want to call it, whatever we're in. So I think the Russell should do fine. I think gold and silver are still coming down. I think they need to come down. I said on a video 5,075.80 was a good healthy level for right now. Yes, but I think that we're still going to see probably $3,500 gold and probably $40 to $50 silver. I think as soon as 2026, but I think the highs are in for at least the next few years. That's my opinions only. So I want to keep dollar cost averaging back into my gold ETFs here. Scoop up shares at hopefully lower prices. CRF, I think, has been a really good indicator of where things are headed. Again, that's tracks the index. So the fact that it's come down about 40 cents rather quickly, I think there is going to be more downside in these markets. Again, we shall see. So love to hear comments and thoughts, what you're doing. Again, I've really enjoyed the comment section, getting to interact with you all. Again, I made a comment this week in a video. If you're just angry and ignorant and have nothing to contribute, please save your comments for something else. It's going to be ignored here. Like I said, this is a place where we can say anything, but if it's off the wall ridiculous, there's no place for it. So trust God, rely on math, rely on charts, ignore the noise. Hope you got something from today. Have a great day.